Good morning from our global headquarters in New York. I'm Manish Krenny. You're welcome to Bloomberg Brief. Let's set your agenda. Eking out gains, U.S. equity markets, inflows roll on for a 10th week, hitting $13 billion. SALT talk back on the table. President-elect Trump's advisors mull doubling the state and local tax deductions. And an AI boost, Broadcom's rosy outlook on chips sends the shares soaring after hours. Good morning to you. We're eking out a little bit of a gains. We turned around in the past hour, up a third of 1% on the S&P 500. We are seeing inflows. The Bank of America flow show comes through. 10th week of inflows into the United States of America equity market at $13 billion. That is a record annually. I can tell you, though, for the 9th day in a row, more constituents fell rather than rally. That is the longest shift in breadth, lower since 2001. So equities are on the up this morning. Roll it over, have a look at the bond market, because what you've got here is volatility at a 3-year low. Yields are up at 2 basis points. When you go to the very long end, there was a $22 billion issuance of 30-year paper. And I like what BMO had to say. There was no desire to pay up. The market did not want to dance with duration. What did we learn from those bond auctions this week? We'll dissect that in just a moment. Let's go back to Broadcom, which is surging in the pre-market. That's after the chip supplier predicted a boom in demand for its AI chips. We'll have more of the story a little bit later in the hour. Also keeping an eye on RH after the furniture retailer raised its 2025 revenue forecast and swung to profit in the third quarter. Warner Brothers Discovery falling after announcing it's reorganizing into 2 divisions, one focused on streaming and studios and the other on cable TV. Divide and conquer, they say. In just a few moments, we'll catch up with Luke Barr of Goldman Sachs Asset Management. A little bit later in the hour, Jose Torres of Interactive Brokers and Maureen O'Connor of Wells Fargo on the credit outlook for 2025. So we're inching back into the green this morning, rounding out a week where, well, you just think of the year, 27% rally so far this year. Goldman Sachs' David Costin looks ahead to next year, predicting another 7% increase in the next 12 months.
The stock market is pricing as though the underlying economic growth is closer to 5%. The economy, of course, is not growing as rapidly as that, but the performance of cyclical stocks relative to defensive stocks is more consistent with a pretty robust economic underlying activity. In fact, that is what most of the fund managers are anticipating. The animal spirits have really been out in force in the last month.
Well, let's get to the same house, different division. Luke Barr is the head of fundamental equity client portfolio over at Goldman Sachs. Luke, good to see you this morning. Listening to your colleague there, this market's trading like it's a 5% growth. It really is rolling higher. Do you get any sense that we're in some kind of an overextension here? I was talking about breadth a little bit earlier. The 9th day in a row when more constituents fell versus a rally. That is the longest run since 2001.
Well, good morning, Manus. And I think first and foremost, what is playing out in markets today is this optimism around some continuation of reform, but frankly, still a very strong, robust, underlying U.S. economic growth outlook. What I would say to your point around diversification and around the broadening out of that growth story is that's actually fairly healthy. We're seeing a market that's focusing on fundamentals, that's looking at how individual businesses are performing and rewarding them accordingly. We do have some caution around valuations in parts of the larger cap space. We need to be thoughtful around that. But holistically, we still see opportunity across the US marketplace. And if you're selective and can find those winners within that complex, that for us is a healthy place to be.
Let's just talk about that broadening, because this is what you say. You expect the return structure of the stock market to broaden in 2025 against a backdrop of easing cycles and resilient growth. High valuations in some areas provide motivation for diversification. Where would you, I mean, look, maybe it's an obvious question. Where is the highest valuation at all? And I'm sort of thinking of the Mag 7 trading on a 41 projected earnings. Is that toppy? Is that lofty?
Look, it's a little bit rich, I think, in some of those areas. Again, you have to be selective around the individual business. And let's not lose sight of the fact that the fundamentals for a number of those still look very healthy. But if you were to look at it from the perspective of where are we finding opportunity, where you're getting attractive and discounted entry point, I would really say go down the cap spectrum into the US smaller cap space, much greater leverage into the continued strong growth domestically, as well as the benefit of reduced rates coming through in the US, which whilst the Fed might be slightly slower than maybe people were expecting earlier in the year, we're still going to see a normalization of rates, and that does feed through into better margins for your small cap space, given these are more leveraged and often floating rate debt users. And so that for us is an area where this broadening story, that pull through of growth into the smaller cap space, given the underperformance you've seen for much of the last 3 to 5 years, is a very compelling starting point.
Luke, how much of that broadening into the small caps is predicated on another, at least, let's say, 80 to 100 basis points of cuts from the Federal Reserve?
Look, I think the market can adjust fairly quickly to expectations around the Fed. So I would actually say a fair amount of that is priced in. And so if we were to see a further slowdown in Fed policy, that might be something we just need to be cautious on. But at this point, look, our expectation is the Fed will move next week, 25 basis points, and then we likely have another 50 basis points in the first half of next year. But then from that point, I actually think the Fed can stay on pause, see what the inflation environment is like, and actually benefit from that underlying strength in growth and fundamentals. And so that environment, even if it's only 75 basis points from here forwards over the next 12 months, still is very healthy for that smaller cap part of the overall US equity landscape.
Well, it is about the trajectory, isn't it? I mean, if we get that, that's 175 basis points, and that's almost as much as we got during some of the more critical moments in markets. Overnight, or over the past 24 hours, we're talking about maybe doubling the SALT limit here in the United States of America. There's a debate about the sequencing of what happens in Congress, whether they go for one bill, all encapsulating, which is tax and immigration, or they split it in two. How important is it for the earnings per share metric, for the growth in equities, that these tax cuts, these corporate tax cuts, come through early and hard?
I actually think, whilst that will be beneficiary to equity markets, clearly you're going to see an improvement in earnings and fundamentals. I don't think it's critical. I think the key driver here is a continuation of US growth in the 2 to 3% range, and actually the continuation of reform, even if it doesn't come first part of the year, if we see that through the latter part of the year, that will be incrementally positive for the US asset class. And I think when we look at that versus other parts of the world, again, we do see opportunity internationally, but we are seeing a much more progressive reform agenda coming through in the US. And within that, we're seeing a stronger growth dynamic. And so, again, thinking about the broadening out of opportunity, it does exist internationally. But there is this reform agenda that is driving things forwards in the US, independent of whether that comes 1st of January or slightly later in the year.
We're going to spend a little bit of time on Broadcom as we go through this show. I think it's the personification of how you can read explosion and propulsion in AI relative to the rest of the semi industry. But you see particular opportunities in the enablers, that, you know, the semiconductors and that area. Is that part of this diversification story for you?
Well, I think it is at the margin. Now, what we have to recognize is for the last 18 months, the way to have played the AI trade and what is reflected in valuations in some of these major players is the semis and hardware trade. And so that GPU part of the ecosystem, where you very much have this demand-supply imbalance as people try to build out their large language models, has meant that you've seen very strong performance. We don't think that is necessarily culminating. We think there's opportunity going forwards, but the valuation that you're being asked to pay for some of those is just a pause for thought. What we would say is, as you break down the opportunity within the hardware side of things, the enablers, as you say, it's the transition from your GPU semis into your ASIC semis. So as you start to develop those models, as they go into operational development and actually start to be utilized, then it's about inference. It's about operational efficiency within your server businesses. And there's some great ASICs semi trades that just aren't necessarily priced in the same capacity because you haven't seen that pull through in earnings in the same magnitude as you might have seen in the GPU space at this point.
Luke, thank you very much. Succinct for Friday. We're back in the green. Let's see how long that lasts. Luke Barrs of Goldman Sachs Asset Management. Other stories trending on your Bloomberg terminal this Friday morning. This is what we got for you. Chinese yields hit a record low. That's after officials vowed to cut policy rates as well as banks' reserve ratios to help boost the flagging economy. On top of the easing bets, bonds also supported by concerns over a potential trade war with the United States. The UK economy contracted for a second straight month, leaving the Labour government's pledge to boost growth in trouble only months after taking power. Consumer services output tumbled 0.6%, including a 2% decline in pubs and restaurants. It suggests the households tightened their belts, possibly fearing a squeeze from the budget. Elon Musk renewed his long-standing feud with the SEC by posting a letter on X that said the agency is investigating Neuralink. The letter said the agency gave Musk a 48-hour window deadline to accept a settlement over the probe or face an enforcement action. The SEC declined to comment. Coming up, double deductions. President-elect Trump's transition team floats raising SALT write-off. More on the tax story next on Bloomberg.
We're cutting your taxes. We're going to cut them very substantially. We got them down to 21% from probably 42 or 44%, depending on where you are. And we got them down to 21. Everyone said that was a miracle. Now we're getting them down to 15, but only if you make your product here. Otherwise, you pay 21, which is not bad. It's in the middle of the pack.
That was President-elect Trump speaking yesterday at the New York Stock Exchange. His team now mulling doubling the state and local tax deduction from $10,000 to $20,000. Joining me now is Anne-Marie Horder. Anne-Marie, look, this was much talked about on the campaign trail, the SALT tax. The question I have in my mind, it's such a political move, but where's he going to aim this at? It's not going to be uncapped. It is going to be capped, we understand. Does he have the votes to do this?
So what the Trump advisory economic team is saying is that potentially they can bring the cap up to $20,000. The issue they're going to have is the very slim majority in the House of Representatives. For Republicans, this is the slimmest majority they've ever had. It's only the second slimmest ever for the House of Representatives, which basically means every lawmaker then becomes king of the hill and can say, I'm not going to vote on any package unless it has XYZ in it. So what you have here is someone like Congressman Lawler, someone like Congressman Nick Lolita, these individuals from New York saying, you know what, maybe $20,000 isn't enough and the cap needs to be higher, which is why when it comes to the tax bill, it's going to be so complicated for every single Republican to agree on, because we're just talking about Republicans in New York. This is really going to benefit blue states with high taxes, New York, New Jersey, California. But if you're a Republican sitting in the Midwest, you don't want to see the tax break go up, period, for those blue states, let alone the Trump campaign team saying we're willing to go to $20,000. Do you see how difficult these conversations can start to get?
And as you say, it is razor thin in Congress. And will the Democrats be wholly united against raising it?
Well, the problem is that it's going to be attached to a slew of other tax cuts that Democrats are going to be against, like potentially a 15% corporate tax rate. Now, even though we heard there from President-elect Trump speaking yesterday at the New York Stock Exchange, talking about the fact that that's only if you make your products here in the United States, the fact of the matter is there's going to be a ton of tax breaks likely in there that Democrats are not going to line up for. So every single Republican will need to say yes on these bills.
And as you said, many new kingmakers. Everybody's emboldened. Now, one leader which is emboldened is, of course, Canada. We're seeing a real shift in the game, I would say. They're considering, and this is their most radical or their end game, is where they would raise tariffs on uranium, oil and potash. But you've got Ontario, Doug Ford threatening to cut off the electricity flow to, I know this is saber-rattling, cutting off the electricity flow to Michigan and to New York. But this is a shift in rhetoric and a shift in game theory.
Of course, they're looking at potentially the gambit of all the retaliatory measures they could take if they had to. And also, a lot of this is likely just rhetoric because they're in the middle of this sort of negotiation. But this rhetoric, especially when it comes to what's going on in commodities, is very important. Oil from Canada, #1 importer. Uranium, incredibly important, especially in the Midwest, coming from Canada. So they're looking at these options. What they are going to do, though, potentially first, is more of the carrot approach, less the stick, which is to put money at the border and say, we heard you loud and clear, Donald Trump. We are going to try to put money at the border so that there's less drugs coming to the United States from Canada, and also to clamp down on some of the illegal migration flows from Canada into the United States. And then the harsher measures will be some of these retaliatory measures. I don't think it's going to come to this. This is all a negotiation at this moment.
Well, let's see whether oil gets a carve out, you know, for starters on the block. It's day two of billionaire and tech joining in on the inauguration. Let's just listen to Jeff Bezos.
I'm actually very optimistic this time around that we're going to see. I'm very hopeful about this. He seems to have a lot of energy around reducing regulation. And my point of view, if I can help him do that, I'm going to help him.
And that was Jeff Bezos speaking at the New York Times Deal Book Summit just a couple of days ago. Meta donated $1 million. Here's Jeff Bezos, $1 million coming from him. And as a kicker, he's going to actually stream the inauguration.
He's going to stream the inauguration.
It's brilliant, isn't it?
So what's interesting is these are just the companies we've heard about.
Right.
Obviously, there is going to be a slew of companies that are lining up, potentially as an olive branch, donating $1 million, which for them really isn't a lot, but it's the notion and this idea that, look, we're giving to your inaugural committee, we are ready and willing to work with this incoming administration. And we've seen that across the board. Meta, Amazon, GM's Mary Barra talking to Axios saying there's actually a lot of synergies between us and the Trump administration. We can work with them. This was someone who worked very closely with the Biden administration. I think a lot of these CEOs have seen how powerful it is if you were in a place like Elon Musk and that bet Musk made on Trump and now his proximity to power.
Well, it's, the smell of power. The other billionaires, tech billionaires, see the advantage and they want to be seated at that table for any negotiation as well. They want their share of voice. Anne-Marie, good to see you this morning. We'll see you a little bit later on, you and the team on surveillance. Anne-Marie Hordown. Coming up, it is a boom for Broadcom. The shares extend their gains on AI optimism. We'll give you the details in just a moment on Bloomberg. It's Bloomberg Brief. I'm Manus Cranny in New York. Let's get you up to speed with the front pages. What's making news around the world? Kick it off with the Associated Press. President Emmanuel Macron is expected to name his new prime minister today. Now, whoever is named will be the sixth prime minister for Macron's presidency. The new premier faces an immediate challenge in thrashing out a budget that they can pass through Parliament. Telegraph, it leads with Luigi Mangione. The suspect charged with the killing of the United Healthcare CEO Brian Thompson wasn't a customer. It dispels the idea that the alleged shooting was motivated by a grievance from his personal experience with the company. A senior police official says it may have been targeted because of its size and influence. And on Bloomberg.com, this is what we lead with. Broadcom surging after predicting a boom in demand for its AI chips. The company expects the addressable market for AI components to reach $90 billion by 2027. With the chip supplier extending its double-digit gains pre-market, and there's a lot of excitement around the AI demand. What do we learn from the release? Tom McKenzie has been parsing that for us. Tom, good day to you. Look, it's a very, very clear bifurcation between AI splendidness and the rest of its market, the rest of its product line, isn't it?
It absolutely is, Manus. You just look to the projected picture in terms of the first quarter, and they foresee growth of around 65% for the AI unit versus about 10% for the rest of the business when it comes to chips, sales into smartphones and EVs, for example. So that bifurcation is absolutely there. Here's what analysts like right now in terms of the numbers. $12.2 billion US just from AI sales in the last fiscal year. They had forecast about $10 billion from AI sales. And in terms of the revenue growth, that is 220% year on year in terms of the demand, in terms of sales for the AI products they supply, in terms of processors and networking equipment, year on year, 220%. And again, that addressable market by 2027 of around $90 billion US. This is a company that feels like it's very well positioned now on the hardware and the software to address that demand that they continue to see in terms of AI, particularly when it comes to data centers. I'll just give you one quote from one analyst, Cantor Fitzgerald, saying Broadcom is a clear beneficiary of AI and it has a strong technology roadmap ahead. Earnings should continue to come in strong.
Look, we saw them do a pretty big M&A deal. They bought the VMware business for just under $70 billion. When you look at the ambitions of this CEO, what does it say about the future? What does it say about 2025? Because they're inextricably linked to what happens with Apple as well. It's one of their biggest customers.
They are. You're absolutely right. Now, Apple as well is making progress in developing, of course, its own chipsets. So we know that there is some attempt there to wean themselves off the dependency they have on Broadcom. Longer term, that could be a challenge. But they have, as you said, Broadcom diversified. The software part of this business is now bringing in revenues almost equivalent to the semiconductors business, largely thanks to that huge acquisition of VMware. So they have expertise now in terms of the software for data centers, but also cybersecurity. Hancock, by the way, the CEO, saying that he is very ready to pull the trigger on more acquisitions in the year ahead. If you're looking for a fly in the ointment, it will be that still pretty tepid demand in terms of the chips going into smartphones, into autos, and into some of the wireless connection devices they build out as well.
Spoiler alert there from Tom at the end of we've got 15% on the board, and you want to end with a spoiler alert. I like your pragmatism. You sound like myself. Tom, thank you very much. Tom McKenzie there on the very latest from Bogcom. I want to give you a quick snapshot of what's going on with equity markets. We've turned it around since I arrived here at 3 a.m. in the morning. We're now up 1/3%. The dollar is flat at the moment. You have a raft of central banks pushing back. Canada, double jumbo cut in sequence. SMB yesterday. So the dollar, the next leg of the dollar will, of course, be defined by what happens with the FOMC. 10-year yields trade at 4.33, bang in the middle of that range from 4.50 on the upside down to 4.15. So we'll keep an eye on that. Coming up, we're going to catch up with Jose Torres, Interactive Brokers, as we set up for a major week of central bank decisions. From our global headquarters in New York, welcome to Bloomberg Brief. I'm Manish Krenny. Let's set that agenda. Eking out gains, U.S. equity markets see inflows roll on for a 10th week, hitting $13 billion. SALT talk back on the table. President-elect Trump advisors mull doubling the state and local tax deductions. And an AI boost for Broadcom's rosy outlook as the chip demand sends shares soaring in the pre-market. Good morning to you. Equity markets are indeed eking out again. Maybe you want to be cautious on the breadth. You've seen 9th day in a row of where you saw more constituents fall rather than rally. That is the longest run since 2001. But tech is definitely bid up this morning. You've got Broadcom up 14%. We'll talk more about that a little bit later on. So tech is infusing that rally in the NASDAQ. And if you'd like a little bit of breadth, the Russell 2000 up 0.2%. I can tell you 10 weeks of inflows into the United States. $13 billion came in last week. Bond markets rise very, very slightly. The 30-year auction, they just didn't want to dance with duration yesterday. That was the lovely line from BMO. But we're flat on those bond markets. Volatility in the bond market is at a 3-year low. That was the surprising fact that I came across this morning. So markets, they're bracing for the last round of rate decisions of 2024 from 3 major central banks next week. Jose Torres, Interactive Brokers, is looking ahead to what comes next year. Monetary policy. The outlook for next year is much more complex, with annualized price pressure figures accelerating for a second consecutive month to the loftiest level since July. He joins me around the desk. So, Jose, good morning. Good to see you. Your concern is about the complexities of 2025 and the inflation narrative. Is that predicated more on supply-side disruption that we simply don't know enough about yet?
Great to see you, Manis. Absolutely. We are witnessing a preview of what Trump 2.0 could be. Beijing is already preparing early for tit-for-tat trade jabs across the Pacific Ocean with Washington. Against that backdrop, you also have some uncertainty with Canada and Mexico on trade. However, Canada and Mexico have been acquiescing more so than the Chinese. The Chinese have been a little more adversarial. Why is this so important? Goods disinflation, Manis, drove the disinflation train from 2022 down to that 2% handle on CPI. We got those 3 handles on PPI. You know, eggs drove a lot of the increase, but PPI historically tends to lead CPI. So when the Trump administration enters next month, you know, I'm a little nervous that goods inflation can become a threat. That's been cooperating the whole time. Services inflation hasn't. So if you have services remaining hot, wages, labor market strong, and then goods strong, you're not in a 2% inflation economy.
Well, look, I think it's whether this market can wrap its head around the fact that it's going to be very difficult to get back to a 2% economy in the United States of America. What do you say to the people that look at the PCE, those portions of PPI that rolled through to PCE, that they were universally weak. Is that not a strong enough argument for you?
No, because when you look at the annualized figures, which are more slow moving and, take a broader approach, they're ticking higher. And when you look at the trend in used and new cars, right, you looked at the CPI, 2% and 0.6% growth month over month, right? That's a fresh burst. We saw for roughly 2 years used cars drop almost every single month across 24-month period, right? So we're starting to see that reinflation, also driven by lower borrowing costs. Fed easing, that's opening up credit availability, making those monthly payments more manageable, not just for automobiles, but also for the furniture showrooms, for the electronic and appliance stores, all those durable good categories.
You mentioned China and Canada. I look at the rhetoric in the last 24 hours from Canada, and it has shifted. This is the game theory shifting, which is they're talking about tariffs on uranium, on potash, on oil. I mean, this would be horrendous for the Canadian economy, by the way, if they were to have this kind of adversarial moment. This is the real risk, retaliatory tariffs, not just from Canada, Mexico, but you can broaden that out to the rest of the world. We haven't even started with Europe, and then we don't really understand what the China retaliatory tariffs might look like. That's the other major inflationary risk for 2025, isn't it?
Absolutely. If you start seeing costs increase significantly, you start seeing restriction, you start seeing routes starting to go the other way, that's going to drive costs higher, bring efficiency lower, and weigh on growth, especially in a lot of those areas that are much weaker than the U.S. Canada, namely, the EU, namely, China as well. Those economies aren't as robust as the U.S., considering that our consumption figures here have been terrific. As far as the job market, I'm also expecting that to reaccelerate. I'm seeing a lift in business sentiment following the election. That uncertainty is now behind us, so I'm expecting hiring to begin to pick up. Before the election, we saw a bifurcation in continuing and initial claims. Folks that lost their jobs or quit, taking longer for them to find work, right? The hiring rate was subdued. Now that election uncertainty is behind us, I think that hiring is going to pick up. That should support consumption alongside fiscal stimulus and capital markets. Like you said, inflation at 3%, that is terrific for equities, right? A lack of Fed agitation opens the door to further valuation expansion in stocks.
But then, given what you've just said, should the Fed really be continuing to cut by 80 to 100 basis points through 2025?
I don't think so. I'm more of a hawk. Our IBKR forecast traders also think that the Fed shouldn't be cutting. I thought they totally jumped the gun in September with that 50 basis point reduction.
So you think we get one more in December and then we're done?
I think that the neutral rate is right around 4%. Right now the market is pricing in roughly two cuts next year. Financial conditions, we look at the Bloomberg Financial Conditions Index, very loose, spreads very light. Corporate balance sheet strong. The other financial conditions indices, for example, Goldman Sachs, Chicago Fed, telling the same story. We're in a very buoyant, animal spirit-filled economy. Look at the rally we're seeing. We're going to probably going to have a Santa Claus rally to finish off the year. We're going to be up 30%. Last year we were up 25%. Come on, this is not restrictive.
I'm coming to your Christmas party. So I mean, Goldman Sachs said yesterday this market is trading as if it's got a 7% growth handle on it. The kind of outlook that you've got at the moment, I mean, it's just nirvana for all assets, is it? I mean, what is the single biggest risk to that bullish view that you put on the table?
Well, I think the biggest risk is going to be an exogenous shock, right? I don't see anything right now that can totally derail, equities. I grew up as a value investor. That's been my forte. So I've had to rewire my brain in terms of how I look at these financial assets. But the equity market is significantly different than it was 20 years ago in terms of who's leading the ship, right? And what the profile of the companies that are really taking charge. It's less financials, less energy, totally different.
Can I just pick up on one thing? You got jobless claims ticking up yesterday. You've got an unemployment rate of 4.2%. Why are you so convinced that perhaps that's the worst in the labor market behind us? Is that what you're saying to me?
Well, the unemployment rate is up to 4.2%, cycle low is 3.4%. During that time and that uptick in the unemployment rate, we added roughly between 2 and 3 million jobs, even though the unemployment rate went up 1%. That is critical to examine, particularly next year when we're talking about immigration, possible enforcement actions, possible deportations. Because we know in the unemployment rate calculation, the denominator is the labor force. So if that declines, if people go back for whatever reason, right, all else equal, the unemployment rate will tick up, even though the number of unemployed persons remain the same. Now, that's going to be inflationary from the wage side. However, reduced immigration could counter the disinflation on shelter costs, perhaps.
Okay, Jose, good to have you with me this morning. I'm coming to your Christmas party because it sounds like all the bulls are going to be there.
You're invited.
Yeah, I'm invited. There we go. We're going to Miami. Jose Torres of Interactive Brokers on the markets this morning. Coming up, we'll discuss what's next for the credit markets. Wells Fargo's Maureen O'Connor joins me around the desk. Let's say that we'll see whether she shares Jose's euphoria for credit. Good morning from Bloomberg.
We've seen the market rally by roughly 5% since the election. You saw recently the NFIB Small Business Optimism Index jump sharply. That's pretty consistent with what we saw in the first Trump administration. The expectation of more business-friendly environment, whether that's true or not, of course, that remains to be seen. CEO confidence is typically highest in a unified Republican government. So that also is, I think, one of the reasons why you've seen we are expecting a 25% increase in M&A activity next year.
Goldman's David Costin looking at a strong M&A market. It'll be boosted by 25%. Does she agree? Maureen O'Connor, Wells Fargo, echoing that view. This is what she says. Debt-financed M&A should remain robust as resilient economic conditions and the possibility of a more favorable regulatory environment drive the incremental acquisition activity. Maureen joins me now. So it's gangbusters for M&A and deregulation. I don't know whether you can sort of follow Jose with a level of enthusiasm. But let's start with the M&A market. There is a big assumption here that we are going to see a material uplift in M&A next year.
Yeah, I mean, I think, listen, the conditions are ripe, right? In the lead-in, you heard about C-suite level confidence. The Fed has stuck the perfect no landing scenario. At least that's the way it looks right now. Debt financing costs, while they're elevated, still remain within historical norms. So I think that the cost to finance M&A, from at least from my market's perspective, feels digestible. We did see an uplift in M&A activity this year as it pertains to the impact on investment-grade credit markets, but we are expecting another roughly 25% boost, so similar to the opinions leading into this segment. So yes, it does feel like the market is ripe for some M&A. There are certain sectors that still look poised for consolidation. Pharma, perhaps energy, some more in tech. So yes, we are expecting a robust calendar.
And if we try and transcribe that flow sheet that you've just laid out into issuance, how does that look?
Yeah, so issuance on the investment grade side has been pretty strong.
Yeah.
This year we're up close to 30% on a year-over-year basis. We're expecting another 10% growth in overall issuance activity. M&A is a part of that.
Right.
So we are again expecting a roughly $250 billion of M&A supply in investment grade on a probably $1.7 trillion number. But the vast majority of the issuance in our market is really just refi needs. When you think about the maturity towers coming due in the next couple of years, they are large. We have $850 billion in maturities in 2025. We have $1 trillion in maturities in 2026. These are record levels for our market. So the market grew after COVID, right? The Fed pumped liquidity into the market, balance sheets inflated. We saw a ton of issuance in 2020 and 2021. The 5-year notes that were issued in those years are maturing, and so we must stay larger.
It's interesting. If I look at the sovereign issuance this week, I think we can walk away with where is demand, which is there was healthy demand for 10s. That's robust. That's fine. That was an appealing yield. Nobody wanted to dance with duration in the 30-year bonds yesterday. Now, that's sovereign. But translate that into your world. What are you seeing in terms of the preparedness to dance with duration?
That's interesting because actually pretty consistently for the last 2 years, it's the long duration bid in our market that has been the strongest.
Okay.
And the reason for that is when you think about who buys investment grade credit, there's a diversity of investors that prop up our market. And a big component of that is U.S. institutional money, and that's driven largely by LDI strategies. So liability-driven investors, insurance companies, pension funds, guys that like higher yields. The pension rotation trade has been well underway now for a couple of years. All of those flows, long duration and focus, because those are matched liability trades. So yes, we actually see deepest bid in 30s, followed by 10s, followed by the short end of the curve.
I suppose the structure of your demand side will drive that, but you're not seeing a massive cheapening up in spreads to get any of this refinancing away either, are you? There's a healthy demand.
Healthy demand. In fact, this is the stat I like the most. Our market issuance was up almost 30% on a year-over-year basis. New issue concessions, so the premium you pay over and above your outstanding paper, that actually compressed by 50% in 2024. So that speaks to how strong the demand dynamics are in our market.
Maybe it also speaks to that people want to take quality. I know there's the whole other rest of the spectrum in high yield and one thing and another, but within your world, which is an investment grade, it is about holding on to quality. Look, we can quote the spreads the tightest in decades in different parts of the markets. I asked you, were you as optimistic as Jose when you sat down in the commercial break? How would you describe your risk appetite at the moment for your market?
Yeah, I mean, I think if you surveyed investors, the overarching sentiment is everybody is optimistic, but cautiously long. You are correct. We are sitting at decades tights in spreads. And, there are little pockets where perhaps there is still some value relative to historical norms, but we're in very rare air here with respect to valuations. They're stretched pretty thin. So what's the upside from here when the market does appear priced for perfection? But at the same time, given the demand dynamics that we just spoke about, it's very hard to be short this market. It's not a trade that's made you any money in the last 2 years. So as long as yields remain elevated and the world feels like a pretty safe place to invest, credit markets are going to be pretty well range bound from a spread perspective going forward, and that's our view.
If we talk about 2025, the risks in equity land, Julian Emanuel in that seat on Monday, and he talked about this exuberance, but the risk is of an exuberant correction. Translate that from equity into your world, because the equity boys and girls are concerned that there will be moments, air pockets in terms of the news flow, in terms of policy flow. Will it be the same in your world?
I mean, I think, sure, exogenous risks are there, and I think that's looming in everybody's heads. What is it that I'm missing? And when we see it, we'll be surprised.
And that's maybe what imbues the caution, the little bit of cautious up.
Correct. I mean, exactly. There's almost no downside risk priced into spreads right now. So what do you do as an investor? Those pockets, we have seen them. I think about this past year, we did have a bout of volatility over the summer with the non-farm payroll miss and the yen carry trade that unwound at that time. Spreads felt that. It was about 2 days of real market volatility. Dips were bought. They were bought pretty aggressively. So obviously, it depends on the severity of the event. More systemic risks, like we saw during the regional bank crisis in 2023, that was a handful of weeks before spreads really recorrected back to their prior volatility, prior catalyst levels. But the reality is, investors, the liquidity that is available on the sidelines, ready to buy the dip, I don't see them being long-lasting to the extent that these are, to use your term, sort of pockets of volatility.
Maureen, great conversation and a healthy level of caution, let's say, in the calls. Happy holidays. I think we're doing that at this stage. Maureen O'Connor there of Wells Fargo. Thank you for joining me this morning around the desk. Let's switch gears a little bit. Let's get back to politics, because that is these markets, essentially. President-elect Donald Trump, his team is considering doubling a popular tax break. It's the SALT tax, and it would provide big savings to high tax states. New York Governor Kathy Hochul calling the plan, quote, nothing more than an empty gesture. She goes on to write this: it fails to deliver the meaningful relief for working families desperately in need as they struggle with rising costs. I fully support a proposal for a complete restoration of the SALT exemption. Joshua Gallo joins me now. Josh, good to see you. Look, this is about a doubling of SALT. I think the possibility of something more unbridled is very, very low. But this is a razor-thin Congress. And the question is there an appetite in Congress to do something very, very significant with SALT?
That's exactly right. It comes down to that congressional margin because, in the end, we're talking about changing it from 10,000 to 20,000. And this is something that, of course, was lowered to 10,000 in 2017 by Trump himself in his tax plan. So it's set to expire next year. And the fact is, this tax break, as the governor pointed out, it really is most beneficial to people who are pretty wealthy. They're in states like New York, New Jersey, California, where people are paying high property taxes. And it doesn't really benefit that many other people. So, whether it would be if they made it unbridled, as you suggested, is very unlikely. Even Stephen Moore said they wouldn't do that. That would be a massive handout. But at the same time, you have people in Congress from New York and those states who are really pushing to reinstate or at least lift it to 20,000.
Well, of course, that's New York, New Jersey, and California. They're going to welcome any shift, from where we are at the moment. I want to talk about one of the stories in the Journal. We've understand that the advisors are wanting to shrink or completely eliminate some of the bank regulators. I mean, this is really quite a surreal kind of proposition. It would be to merge or eliminate some of the bank regulators. Think of the FDIC, the Office of Comptroller and of Currency. Again, this would take Congress to get this kind of dramatic shift in legislation, but it also involves the possibility of the insurance policy, the deposit insurance policy, being absorbed into the Treasury.
Yeah, that's complicated. Anytime there's significant change to financial regulation, there are just a number of parties that come out and the fight is intense. I think there are really two sides to this. One is this drive for efficiency, driven by Elon Musk, of course, in the new office. And then on the other side, a desire to always simplify and in many cases remove regulations, which is obviously a clear priority of Trump's administration. So, but the fallout of that, right, to real people is very hard to gauge. And when you talk about something like deposit insurance, any kind of change to that is a massive signal to depositors that could have quick ramifications of people moving money, losing confidence. So that would be taken with pretty careful steps, I would think.
Josh.
Then on the other hand, you have the push for deregulation, which is another ball.
Of course, and let's see what scale of that is delivered. Joshua Gallu there on the very latest political stories on Bloomberg. Coming up, President Biden attends his last G7 meeting. We stay on watch for a new French Prime Minister right here on Bloomberg. A look ahead through the weekend for you. President Biden will join a virtual G7 meeting as world leaders brace for Trump's return. To France, President Macron is expected to name a new prime minister, probably today. And the vote on the impeachment of South Korea's President Yoon is expected to take place on Saturday. So by Monday morning, you're going to have a feast of news, potentially. Broadcom is absolutely powering ahead in this pre-market trade. Pretty strong news on their AI sales surging. Norwegian Cruise, another upgrade raised to overweight at Barclays. And Warner Brothers is dropping double-digit gains in the previous session on the back of the announcement of a restructuring of the firm.